Welcome to our deep dive on the Mega Backdoor Roth 401k strategy for high earners. In this video, we will explain what the MBDR is, how the math works, how to avoid pacing mistakes with bonus-heavy compensation, and how to implement dynamic contribution strategies to hit the annual limit without losing employer matches. Let's get started. Here's our agenda. First, what the Mega Backdoor Roth 401k is. Next, the simple math behind it. Then, the pacing problem and why bonuses complicate things. After that, we'll cover 2 dynamic contribution strategies. We'll also emphasize immediate conversion best practices. We will finish with a planned checklist, pitfalls, and a couple of quick quizzes. This video is for educational purposes only and is not financial, legal, or tax advice. Always consult your employer's plan documents, a qualified tax professional, or a fiduciary advisor. Contribution limits, eligibility, and plan features change over time and vary by employer. Your plan must specifically allow voluntary after-tax contributions and in-plan Roth conversions or in-service rollovers for the Mega Backdoor Roth strategy to work. The Mega Backdoor Roth is a legal strategy that leverages voluntary after-tax 401k contributions and immediately converts them to Roth. For high-income earners, this method can significantly increase tax-advantaged retirement savings by channeling funds into a Roth account, where future growth and qualified withdrawals can be tax-free. Mechanically, your paycheck can fund 3 buckets: pre-tax or Roth elective deferrals, voluntary after-tax contributions, and you may receive an employer match. If your plan allows it, you immediately convert voluntary after-tax dollars to Roth via in-plan conversion, or roll them out to a Roth IRA using an in-service distribution, if permitted. All these contributions, elective deferrals, employer match, and voluntary after-tax, count toward the annual Section 415C total contribution limit, which, for example, is $70,000 in 2025, with additional catch-up contributions allowed if you are age 50 or older. The immediate conversion minimizes any taxable earnings accumulated while funds sit in the after-tax subaccount. The core calculation is straightforward. Your maximum voluntary after-tax contribution equals the IRS total contribution limit minus your elective deferrals minus all employer contributions, including the match. For example, if the limit is $70,000 and you contribute $23,000 through elective deferrals and receive a $7,000 employer match, the remaining after-tax room is $40,000. Always verify current year limits and your projected compensation and employer contributions. Administrators typically implement contributions as a percentage of pay. If a large bonus hits early, that percentage can push you to the total annual limit prematurely. Once you reach the total contribution cap, further contributions and the associated employer match may stop for the remainder of the year. This can lead to forfeited employer match and an inefficient use of the available limit. Comparing the 2 approaches. An equal payment method is simple but risky if you have large early year bonuses, because you may hit the total limit too early and lose out on match later in the year. The dynamic method, in contrast, requires periodic adjustments to contribution percentages. It aligns with the timing and size of your bonus and your ongoing salary, helping you both reach the total limit precisely and preserve employer matching throughout the year. Here is a practical plan. First, use strategy 1 by setting a high after-tax contribution percentage for the bonus paycheck only, so the bonus fills a large portion of your after-tax room. Second, use strategy 2 by recalculating the necessary percentage after the bonus has been paid and adjusting as needed during the year to land precisely on the total limit without exceeding it. Coordinate with human resources or payroll to confirm how deferrals and employer match are applied across pay periods. Track your cumulative totals monthly. Finally, plan for immediate Roth conversion of each after-tax deposit so that minimal earnings accrue in the after-tax bucket. This timeline illustrates the entire year. In February, a large bonus lands, and your contribution percentage is temporarily elevated for that paycheck to capture after-tax room efficiently. In March, you shift to a recalculated steady percentage for regular paychecks, which continues through December. The cumulative contribution line rises sharply with the bonus, then climbs at a controlled pace to hit the annual limit exactly at year-end. Each after-tax deposit is followed by an immediate in-plan Roth conversion to minimize taxable earnings in the after-tax sub-account. A warning marker near March highlights the risk of hitting the cap too early if you fail to adjust percentages after the bonus. Quiz time. Which formula correctly determines your maximum voluntary after-tax 401k contribution? Option A. IRS total contribution limit minus your elective deferrals plus employer contributions. Option B. Your elective deferrals plus employer contributions minus the IRS total contribution limit. Option C. IRS elective deferral limit minus employer match. Option D. Employer match multiplied by your contribution percentage. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is option A. Your maximum voluntary after-tax contribution equals the IRS total contribution limit minus the sum of your elective deferrals and all employer contributions. This is the basis for calculating your after-tax room. Immediate conversion reduces the chance that the after-tax sub-account accrues earnings, which would be taxable upon conversion. Depending on your plan, you can use in-plan Roth conversion or, if permitted, an in-service rollover to a Roth IRA. Some plans allow automated or scheduled conversions, which can simplify administration and reduce delays. Use this checklist to verify plan eligibility and mechanics. Confirm that voluntary after-tax contributions are allowed. Check whether in-plan Roth conversions are available and how often they can be executed. If not, determine whether in-service distributions to a Roth IRA are allowed and under what conditions. Understand the employer match formula, including any true-up policy, to avoid forfeiting match due to pacing errors. Know whether contributions are percentage-based or allow flat dollar inputs, since that affects bonus handling. Be aware of non-discrimination testing and the potential for refunds to highly compensated employees. Finally, note payroll deadlines for making contribution percentage changes. Second quiz. When should you convert voluntary after-tax contributions to Roth under a Mega Backdoor strategy? Option A. Immediately after each deposit. Option B. At the end of the year. Option C. Only after you reach the $70,000 total limit. Option D. Never leave funds after tax for the year. You may pause the video now to think about the answer. We will cover the correct answer next. The correct answer is option A. Converting immediately after each after-tax deposit minimizes taxable earnings in the after-tax sub-account and keeps the process clean and consistent. Here are the common pitfalls. First, reaching the annual cap too early, because an early bonus triggers high percentage contributions, which can forfeit matching contributions later in the year. Second, delaying conversions, which can create taxable earnings. Third, overlooking non-discrimination testing and the risk of refunds for highly compensated employees. Fourth, assuming your plan permits this strategy without checking plan documents. Finally, neglecting to update for annual limit changes and failing to recalculate contribution percentages during the year. Here is a quick Markdown recap. First, the Mega Backdoor formula. After-tax room equals the total 415C limit minus elective deferrals minus employer contributions. For example, 70,000 minus 23,000 minus 7,000 equals 40,000. Next, the dynamic strategy. Set a high after-tax percentage for the bonus paycheck, then recalculate and set a steady percentage for the remaining paychecks, and convert after-tax to Roth immediately. Finally, key reminders include confirming plan allowances, tracking cumulative totals monthly, and monitoring non-discrimination testing risks. In summary, the Mega Backdoor Roth strategy can significantly increase tax-advantaged savings if your plan allows voluntary after-tax contributions and conversions. Use the simple formula to compute your after-tax room. Avoid the pacing trap created by early bonuses. Adopt dynamic contribution strategies and convert immediately after each deposit. Finally, verify plan rules, closely monitor totals, and update calculations annually. Thanks for watching. If you found this helpful, please like the video, share it with someone who has a bonus-heavy paycheck, and subscribe for more advanced retirement strategies. Drop your questions, experiences, or tips in the comments. What dynamic pacing method will you try this year?